co-sponsor, Felix Ortiz from the Assembly, unfortunately had a travel commitment that he could not change. It's been extraordinarily difficult to get this scheduled because everyone here apparently triple books themselves all the time. So even though Felix couldn't be here, we decided we were sticking with this date and we'll be reporting back into him and his office. So without any more discussion, Vicki Fuller, do you want to come stand up here or would you like to sit?
I'm happy to stand.
Fine.
Good morning.
Good morning.
I've been working for the Office of the State Controller, I guess since August of 2012, and I remember doing the very involved interview process. A lot of the discussion I had with staff and with the comptroller was on issues of ESG. And I must say, I had followed the comptroller's work from my previous employer, Alliance Bernstein, and one of the key attractions for me of the potential of working with him and his staff was what I viewed to be exceptional and forward-thinking approaches as related to climate change. So I am the Chief Investment Officer. I'm thankful to be part of this discussion and let you hear from me as a representative of my staff how we think about this very important issue. So let me start by saying that there's no controversy in our thinking, and by that I mean we agree that based on scientific evidence, climate change is happening and human activity is a primary contributing cause. Before I joined the comptroller, I think it was 2009, I went on an excursion to Antarctica with several friends, colleagues, and actually members of the scientific community. And I got to observe firsthand the glacier activity and the impact that climate change was having on the animal population in Antarctica. And I must say that that influenced me greatly, personally, and I bring that awareness to what I do every day in seeking to provide a sustainable future for the 1 million people that we serve. At New York State Council, we have committed tremendous resources, both our asset class heads, our corporate governance engagement group, and the retention of advisors to helping us ascertain what we can do with our $180 billion portfolio to make sure that we're preparing for a sustainable future. So the presentation or the talking points that I'm going to walk through will address several questions you have raised. But let me first discuss the issues that form the basis of our investment strategy. The comptroller has charged me with making sure that ESG factors, particularly climate change, become an integral part of our decision making. And in fact, our investment philosophy, I think the fourth tenet says that we believe that ESG factors are both a risk, significant risk for the fund, and also provide tremendous opportunities. So, we as a matter of strategy have decided, way before I got to the plan, that in the large cap space, that it made more sense to passively manage our portfolio. Because it had been shown time and time again that it was very hard for external managers to provide alpha or return over the benchmark. But we do also employ active strategies, and that is an area that we are seeking to grow. We have already committed about $1.5 billion to sustainable strategies and have announced publicly our desire to add $1.5 billion to those strategies going forward. The breadth of our investments, the allocation of our assets, and the manner in which we execute and manage these investments reflect informed and what we hope are deliberate investment strategies adopted by the comptroller in furtherance of his fiduciary duty. Under the leadership of Comptroller DiNapoli, the fund has adopted a proactive and integrated response to climate risk through investment strategies, engagement with portfolio companies, and advocacy. Recently, we confirmed that these efforts are paying off. In measuring the carbon footprint of the fund's global equities portfolio, we determined that the portfolio had a 15% lower total emissions profile than our benchmark. So to more clearly quantify potential physical and regulatory risk to the fund posed by climate change, the fund participated in a study undertaken by Mercer. The Mercer report, tailored to the fund, notes that under a 2-degree scenario, the risk of losses are associated with concentration of our holdings in global equities, including U.S. public equities, developed market, global equity, and small cap equity. In response, the fund is implementing strategies recommended by Mercer. Many of you may have read that in January, the fund made its initial investment of $2 billion in a customized, risk-aware, low-emissions index. The index fund underweights investments in large contributors to carbon emissions and increases investments in companies with lower emissions and comparable returns. For us, this was, after measuring our, at least taking the first decisive step in measuring our carbon footprint and reflecting on the work of Mercer, we asked ourselves for this very complicated issue where in our index portfolio, some 7% of our fund is exposed. What could we do while we continued to research both the footprint of our overall portfolio globally and different investment strategies? This was not meant to be the total answer to the question, but it was, in our opinion, a very important first step. An integral part of this strategy is engagement. That is something that we are known for. We're well thought of. We take to heart our responsibility as long-term holders, and we do actively engage our portfolio companies. And we're patient. And so if we think a particular issue requires our attention, we will engage the company, write letters, propose resolutions, vote against board members. And if we are not successful the first time, we keep coming back. And that effort, that approach has borne fruit for us. We know some people don't believe in engagement, but I can tell you for us, the proof is in what we've been able to accomplish. The engagement effort for the low carbon index will be with companies that do not report emissions or have high carbon emissions relative to peers to encourage their management to report on and reduce emissions. This low emission index provides an innovative, we believe, equity index strategy without adding risk, in our parlance would be tracking error, to the fund's passive holdings. And the whole mandate of the passive strategy is to take very little tracking error versus the index. We are also, as I indicated earlier, allocating additional monies to sustainable strategies. Investments in renewable energy and other sustainable strategies are also priorities of the comptroller. He recently committed $1.5 billion, and that was not meant to be a ceiling. It was meant to be a message to the market that if there were strategies that we should be looking at, we were open for business. So that's a floor. If we see more opportunities than that, we will take them on. Climate risk has been a primary focus of the fund's corporate engagement strategy throughout the comptroller's tenure. This year, we're glad to say, the Asset Owners Disclosure Project, an international organization established to protect retirement savings and other long-term investments from the risk posed by climate change, endorsed the fund as the top fund in North America for our work to mitigate risk associated with climate change, giving the fund its highest ratings. And that was nice, but that wasn't why we did it. But it was also thoughtful to have someone opine that we were at least, in their opinion, on the right path. For example, we submitted a shareholder resolution to ExxonMobil asking the company to assess and report on how its business model will be affected by global efforts to limit the average rise in temperatures to below 2 degrees Celsius. This resolution garnered the support of 38.2% of shareholders at the company's annual meeting in May this year, representing a record level of support for climate change at the annual meeting. And we had also engaged in letter writing to the SEC. And we can't confirm this, but we do believe that the recent activities that the SEC had engaged with Exxon was at least partly attributable to the very vocal position we have taken with that company. Together with other institutional investors, the fund has sponsored over 40 resolutions calling on portfolio companies to assess risks to their businesses posed by climate change and to develop strategies to address them. In 2015 alone, we reached agreements with 5 of these companies. And we also regularly vote our proxies in support of climate resolutions. Our strategies to address climate risk are developed to overcome the consequences of a fragmented regulatory landscape. Climate change, in our opinion, poses a risk that could affect the market as a whole. And the fund's advocacy activities focus on strengthening the regulatory support for effective action to build well-designed markets and scale up low-carbon investments. We have supported many specific climate change mitigation policies, and we have used our voice as a shareholder in urging the SEC to promulgate and enforce robust rules. The Comptroller has heard from various groups and individuals who advocate for the divestment of investments in fossil fuel companies. Like them, he and I are deeply concerned about the risk of climate change and have implemented many initiatives to protect the fund's investments. As the trustee, however, the Comptroller has determined that divestment of the fund's fossil fuel holdings is not appropriate at this time. Decisions to divest are among the most complex investment decisions a trustee makes, particularly when an active part of the investment strategy is to employ index strategies. We understand that it is not necessarily the case that the past is the prologue for the future. And so we're not blinded to the notion that how passive index strategies have worked in the past may not be the way they work in the future. However, if we decide to pivot to something different, we do have to have, in our opinion, the force of our own research and our own investment strategies to do that. The Comptroller is legally bound by a fiduciary duty to act prudently and solely in the interest of the retirement system participants. And as interpreted by the Court of Appeals, those participants are entitled to the constitutionally protected benefit of the Comptroller's freedom to exercise his independent judgment in fulfilling that duty. I might add that while we, as the staff and the Comptroller, do believe in the pernicious effects of climate change, we do hear from retirees who don't believe that. And so for them, we need to make sure that they know that any decisions we make are not without evidence that we can provide to them should they question what we do. In those limited instances in which the fund has divested, the fund did so to mitigate a precise, identified, unacceptable level of risk where we could really wrap our head around what the risk might be. Many times it might have been that the exposure of the fund to the particular holding was de minimis. And even then, whether it was a small investment or not, we did extensive research. We talked to analysts, we interviewed, we talked to retailers, etc. So we take this responsibility quite seriously. Whether investment decisions are consistent with the comptroller's fiduciary duty must be analyzed on a case-by-case basis. The analysis starts and ends with the expected impact the investment decisions will have on the fund and whether it would further the purpose of providing benefits to the retirement system participants. Now, with respect to a broad restriction on all investments in fossil fuel producers, such action is not consistent with the comptroller's fiduciary duty. First, it's indiscriminate. It preempts the thoughtful analysis of a fiduciary that he or she is required to undertake to assess the expected impact on the fund. Second, an industry or sector-wide restriction disregards the fact that the fund is strategically and broadly invested across all sectors and industries to best enhance returns and balance risk. Prohibiting investments in a selected sector would disrupt this strategy. That in and of itself does not prevent us from taking action, but it does require us to make sure that we won't have seller's remorse. If we make the unilateral decision without thoughtful research to remove ourselves from a very important sector that affects the global economy, if we have not thought that through, we won't earn it back. At the current time, the renewable industry doesn't offer us enough to offset it. We know because we're asking for renewable investments. We also are a large investor. So the strategies that we need to look at are different than a fund that might be much smaller than we are. Fossil fuel companies, we believe, will continue to play an integral role in powering the world's electricity generators, industries, transportation, and infrastructure. And while cleaner forms of energy are gaining ground, the role of fossil fuels will not end tomorrow and may not end for decades. As the fund's fiduciary, the comptroller believes it is prudent to maintain investments in those companies whose products are driven by consumer demand. Importantly, though, he views active engagement with these companies as an integral component of addressing investment risk and as essential to effectuating long-term business model changes that will meaningfully reduce those risks. These companies will have a large impact on global efforts to meet the aggressive goals to address climate change, and as such, continued engagement remains, in our opinion, the best way to not only protect the interests of the fund, but also to persuade the companies to acknowledge and address the move to a low-carbon economy. Selling shares to other investors who might not share our concerns about these issues, or worse, deny climate change and support the status quo is not, in our opinion, a wise or prudent option. That will not move the needle, we believe. To ensure that the fund benefits from the move to a low-carbon economy, the comptroller has directed investment staff to seek prudent investment in renewable energy and sustainable investments. We've talked about our investment in the low-carbon index. We also invest in World Bank bonds, public equity vehicles like Generation, and private equity such as Hudson Clean Energy Partners. The comptroller is committed to addressing investment risks related to and capitalizing on the opportunities resulting from the global challenge of climate change. The approach that the comptroller has chosen, we believe, is purposeful, it is robust, and is a prudent allocation of the fund's assets to low carbon investments. Finally, the comptroller has concluded, based upon substantial research and analysis, as well as advice of his legal and investment staff and advisors, that broad sector-focused divestment is not the most effective way to produce change and does not comport with his fiduciary duty. A fiduciary duty, in our opinion, does not say that you could not sell. Again, we are investors. We have no desire or intention to sit idly by with our head in the sand as climate change evolves. But we must, for the benefit of the 1 million people we serve, be sure that the approach we take, whether it ultimately is right or wrong, is supported by sound investment research. Thank you.
Thank you, Vicki.